So today is the second session of our ongoing chapter, which is various purposes of valuation, which carries 4 marks for theory and up to 20 marks of numericals may come out of it. So in today's session we are going to cover valuation standards as per provisions of Companies Act. After that, Indian accounting standards, which are relevant for valuation of properties, and then roles, functions and duties of valuer. This is the syllabus for this chapter as per IBBI curriculum. So this part we have already covered in our session number 1, which was primarily focusing on various purposes of valuation. We also discussed some examples and numericals from examination perspective in session number 1. In today's session we are going to cover this part, and in third session we will discuss capital gain methods, case studies, numericals, formulas, techniques, tricks, tips, and in fourth session we are going to discuss cost index method, examples, case studies along with formulas. So what is Companies Act? The Companies Act is an act of Parliament of India on Indian company law which regulates incorporation of a company, responsibilities of a company, directors, dissolution of a company. So these are the from IBBI examination perspective, though this law is a big one and even 100 hours is less than for covering the complete law, but from examination perspective only few things are required to be noted. So one important thing is that we should know various types of companies and their important features. Any 1 mark theory question can come out of this portion. So primarily these are the main types of companies as per the Companies Act: private company, public company, one person company, foreign company, government company, the listed company, dormant company, and Nidhi company. So this is a comparative table showing the comparative analysis between the private and public limited company. So please remember these common features, important features, out of which 1 mark theory question can come in IBBI examination. So if we talk about private company, then minimum members, member means shareholders here. So minimum number of members or shareholders in case of private company as per Companies Act is 2. However, for public company the minimum number is required as 7. So maximum number of members or shareholders in case of private company is 200. However, in case of public company it can be unlimited. Minimum number of directors in case of private companies 3, and in case of public companies, in case of private companies it is 2, and in case of public company it is 3. And minimum capital in case of private company is 1 lakh rupees, in case of public company is 5 lakh rupees. And transfer of share is not allowed in case of private company, it is restricted. However, in case of public company, shares can be allotted to the public in general. One person company, it is a new type of company introduced in Companies Act 2013 and has only one person as its member. So it is nothing but a hybrid model of sole proprietorship and the company form of business. So it has been provided with concessional and relaxed requirements under the Act. So previously sole proprietorship firm used to exist, and even today it also exists. So just to formalize that single man arrangement, this one person company concept has been introduced in Companies Act 2013. Foreign company, a company in which incorporates outside India and has a place of business in India, whether by itself or through an agent, physically or through electronic mode, and conducts any business activity in India in any other manner. So next type of company is government company. It is a company in which more than 51% of paid up capital is being held by state government and or central government. Listed company, it is a company listed on stock exchange like NSE, BSE, etc. Dormant company, a company formed under the Companies Act for future project or to hold an asset or intellectual property and has no significant accounting transaction. It is called Dormant Company. Nidhi Company, it is a company incorporated with an objective of cultivating habit of savings among its members, receiving and lending money to its members only for their mutual benefit. So these are a few important sections of Companies Act 2013 which are relevant for valuation of properties, and 1 mark theory question may come out of number of section and scope of each of these sections. So first important section from valuation perspective is section 192 and subsection 2. It talks about restriction on non-cash transactions involving directors. Then second important section from valuation perspective is section 230(1)(2)(3). It talks about power to compromise or make arrangements with creditors and members, compromise, arrangement and amalgamation. Then section 231, power of tribunal to enforce compromise or arrangement. Section 232, it talks about merger and amalgamation of companies. Section 247(1), it is very important section and we will see further details in next slide. However, this section talks about qualification, experience, process of registration of valuers and penal provisions for valuers. Subsequently, the Companies Bill 2017 was published based on this section. Then last important section is 281(1). So it talks about submission of report by company liquidator. Now let us talk about section 247 and what are the penal provisions given in the section 247(1) in the Companies Act. So if valuer is found guilty of contravening the provisions of this section, the valuer shall be punishable with minimum fine of 25,000 rupees, which may extend up to 1 lakh rupees. 1 mark theory question is almost expected from this only one slide. So if the valuer is found guilty, then fine up to 25,000 and may ranges up to 1 lakh rupees. If valuer contravenes with provisions of this section with an intention to defraud the company or its members, shareholders, valuer shall be punishable with an imprisonment of term up to 1 year and minimum fine of 1 lakh but may go up to 5 lakh rupees. Where the valuer has been convicted, declared guilty of a criminal offence, he shall be liable to refund the remuneration received by him to the company and pay for damages to the company or to any other person for loss arising out of incorrect or misleading statements of particulars made in his valuation report. Next topic is Indian accounting standards which are relevant for valuation of a property. The classification of assets determine which IAS, Indian Accounting Standard, or IFRS applied. So for valuation of real estate, accounting standards that are required are as under. So these are the 5 important standards from valuation perspective. So Ind AS 2, IAS is also called Ind AS, Indian Accounting Standard 2, talks about inventory. So please note down these 5 accounting standards and their scopes as well. So 1 mark theory question can come out of this slide. So Ind AS 2 covers the inventories, talks about inventories. Ind AS 16 talks about PPE, property, plant and equipment. Ind AS 17 talks about lease. Ind AS 36 talks about impairment of assets, and Ind AS 40 talks about investment properties. Let us see each of these one by one. So first, because inventory is something like related to plant and machinery, so we will not take a focus on that. So we will focus on other 4 IAS, not on Ind AS 2. So first important IAS is IAS 16 PPE, property, plant and equipment. So PPE is recognized when the cost of an asset can be reliably measured and it is probable that the entity will obtain future economic benefits from the asset. So basically the cost of an asset can be reliably measured, so it should be measurable. with a good probability, and it is probable that the entity will obtain future economics. So it is likely to be generate some future benefits for the benefit of the company. The assets should be is likely to generate some future economic benefits. So PPE is measured at initial cost and include or exclude following items. So while calculating total capitalized value of the plant, property and equipment, so normally we capitalize initial cost and we include certain items out of initial cost, or we can exclude some cost from that initial cost which are as under. It includes cost to acquire the asset, net of discounts and rebates. So whatever cost I have incurred after say I have purchased item of 100 rupees, I got a discount of 5 rupees, so net cost is 95 rupees. So that will be considered into the initial cost of PPE. So includes any directly attributable cost required to bring the asset to working condition, including import duty and non-refundable purchase taxes. Deduct accumulative depreciation and any accumulated impairment losses. Impairment we will see in next slides. So whatever depreciation or the impairment has been incurred till date, that has to be deducted from the cost. Add subsequent expenditures relating to an item of PPE if it is allowed to be capitalized, meeting recognition criteria as per Ind AS. So deduct the carrying amount of the parts replaced if recognized in past. So basically whatever certain stores, spare parts, small items which have been purchased subsequent to the machinery, if they meet the recognition criteria as per Ind AS, so we have to capitalize those items. And if certain items which have been discarded or removed from the machinery, so and earlier they were recognized or capitalized as a capitalization cost as part of the machinery, then we have to deduct from those items from the PPE cost. In case PPE comprises of parts having different useful lives, depreciation is calculated on each individual part's life. So if a plant of machinery is having different components with different lives, useful lives as per guidelines, so different depreciation is being calculated on the different parts accordingly as per the individual life of each part. So cost of major inspection of PPE or overhaul of an item occur at regular interval over the useful life of the PPE is capitalized to the extent that it meets the recognition criteria of an asset. So whatever cost of inspection of the PPE we have to incur, if that cost meets the recognition criteria as per Ind AS, then we can also capitalize that part of cost. In case of cost method, value is calculated basis initial cost of acquisition minus depreciation thereon. However, in case of revaluation method model, the PPE is being revalued at a regular interval and depreciation is being charged according to new amount. Next important Ind AS is Ind AS 17. It talks about leases. A lease gives one party, the lessee, the right to use an asset over an agreed period of time in return of payment to the lessor. So the payment is lease, rent. Lease rent is a payment, and it has to be made by lessee to the lessor. So accounting depends on the following type of lease. So financing lease and operating lease. So what is financing lease? The lessee or tenant has almost all the risk and rewards of ownership in case of finance lease. The lessee recognizes the leased asset and corresponding obligation to pay rental into its books. So that means in case of finance lease, lessee takes the benefit of depreciation. Please note down this sentence, that in case of finance lease, lessee takes the benefit of depreciation. 1 mark theory question can come that in case of finance lease, who takes the benefit of depreciation? Lessee, lessor, either of two, both of them. So 1 mark theory may come out of it. However, the lessor recognizes the leased asset as receivable. So in the books of lessor, that asset will be recognized or appeared as receivable in the balance sheet. We'll have further discussion in accounting section, accounting chapter, which we are going to have in the subsequent sessions. So the receivable is measured at the net investment in the lease that is the minimum lease payment receivable discounted at a internal rate of return of the lease plus unguaranteed residual that accrues to the lessor. So basically whatever future rent is expected out of that asset, out of that property or asset, is being capitalized, and that capitalized value is being recognized as a receivable in the books of lessor. Operating lease, lessee doesn't recognize an asset, and lease obligations and the rental paid are normally charged to the income statement of the lessee. So basically in case of operating lease, lessee doesn't recognize that asset, doesn't appear in the balance sheet. Whatever payment, annual payment or quarterly or monthly payment the lessee makes to the lessor, that directly go into the P&L of the lessee, tenant. The lessor continue to recognize the lease asset and depreciate it. So in case of finance lease, the asset was appearing in the balance sheet of both. In case of lessee, it was appearing as asset, and lessee was taking benefit of depreciation, and in case of lessor, it was appearing as a receivable of the capitalized value of the future receivable. However, in case of operating lease, the asset is not appearing in the balance sheet of lessee. However, it appears in the balance sheet of lessor, and lessor continue to take benefit of depreciation. So please note that linked transaction with the legal form of a lease are accounted on the basis of their substance. So whatever content is there, that depends, whatever linked transaction are there, so that depends on the content of the lease deed. The best example of this thing is that a sale and a lease back arrangement. Next accounting standard is IAS 36, which talks about impairment of assets. The basic principle of impairment is that an asset may not be carried on the balance sheet above its recoverable amount. So what is recoverable amount? Recoverable amount is defined as the higher of the asset's fair value less cost of disposal or its value in use. That means we will deduct cost of disposal from assets fair value, one figure, and then we will again deduct assets fair value in use from assets fair value. So whichever higher of these two will be equal to recoverable amount. 1 mark numerical may come, and examiner may ask aspirants to calculate recoverable amount of an asset by providing all these information. So fair value has been explained in Ind AS 113. It provides guidance for fair value measurement, and value in use is equal to present value of future pre-tax cash flows to be derived from the asset. So whatever before tax cash inflow are likely to be generated by the asset, the present value of all those future cash flow from an asset before tax, applying the tax, is equal to value in use. Next concept related to impairment of asset is carrying value. So if carrying amount of an asset exceed its recoverable amount, which we calculated in the last slide, then the asset is said to be impaired. Impairment test. Impairment test is normally done annually. This is the frequency of the impairment test, and however it can be done any time during the annual period. So there is no specific period that it has to be done in March, February or January. Any particular, on a particular date a company can do test. However, the test should be performed at same time every year. So company has to fix certain date that every year, say in January, on 31st January the company will do impairment test. So it should be consistent in terms of doing test on the specific date. So 1 mark theory question may come out of this slide as well. Factors causing impairment. So they are broadly speaking, there are two types of factors: external factor and internal factors. So external factors are like change in technology, market, economic or legal environment, or increase in market interest rates, etc. Internal factors can also cause impairment of assets. Internal indicators could be like obsolescence or physical damage of an asset, or evidence from internal reporting that the economic performance of an asset is or will be worse than expected. Cash generating unit. This is also one important terminology on which 1 mark theory question can come, and it is related to impairment of asset. Since an asset seldom generates cash flow independent of other asset. Thus, most assets are tested for impairment in groups of assets called CGU, cash generating unit. So since assets rarely generate cash flow in an individuality, so there is a group of assets which generate certain cash flow. So that group of asset which is which combinedly generate a unit of cash flow is called cash generating unit. A CGO is a cash generating unit is a smallest identifiable group of assets that generates inflow that are largely independent from cash flow from other sources. So basically, one cash flow from one CGO remain independent of the cash flow being generated by the other unit. Reversal of impairment loss. Impairment loss except goodwill pertaining to prior period shall be reversed if and only if there has been a change in estimated cash flow used to determine the asset's recoverable amount since the last impairment was recognized. An impairment loss recognized for goodwill is not reversed in any subsequent period. So other than goodwill, these are the provisions for doing reversal of impairment loss if there is a change in cash flow causing change in assets recoverable amount since last impairment. Next important Indian accounting standard is IAS 40, and it talks about investment properties. Investment property is a property, it can be land or building or both or part of a building held by an entity to earn rentals and or for capital appreciation. The objective of holding the property by an entity could be rent, generate rent, or for capital appreciation, or for both. This category includes under construction properties and all other properties which fall into either PPE as per Ind AS 16 I discussed in previous one, or inventory as per section IS Indian Accounting Standard 2 category. Initial measurement of an investment property will be at cost. However, subsequent measurement of investment properties is equal to, subsequent value is equal to cost, initial cost minus accumulated depreciation minus accumulated impairment losses, which we discussed in previous Ind AS. Please note that the fair market value of investment property is disclosed in notes of the balance sheet. So as a valuer, if we have to see previous values of the investment properties, so that we can go through the balance sheet of the company and notes of the balance sheet of the company to have an idea of the previous valuations of the investment property which we are going to value. Now let us talk about role of a valuer. A valuer plays a role of an advisor to his client. As an advisor, a valuer should give his own independent, honest and conscious opinion and advice instead of advice tailored to suit what the client desires. A valuer may be required to advise on fair market value. As a valuer, I may be required to give fair market value of a property and future trends in the property market. Valuer's opinion and advice on whether prices are reasonable and are likely to be maintained, sustainability of the prices, also about any possibility of change in rental and capital value. Maybe I may be required to give my advice on these two aspects, rental and capital value changes, likely changes. In case of investment property, valuer's opinion may be required on policy matters like how much reserve fund or sinking fund should be created for future repair or redemption of capital. So I may be required to create some sinking fund. So for that purpose, I may be required to give valuation of an asset. In case of statutory valuation or land acquisition valuation, the valuer need to take consideration into the applicable statutory provisions like date of valuation, date of notification as per the statutory act or law. Valuer opinion is often required for estate management as well. So these are the roles of the valuer. A good estate management has following two objectives. So one theory question can come out of it: maximizing income and capital value and securing good maintenance. Please remember these two objectives of estate management under role of a valuer. Next is what are the functions of a valuer. Theory question can come out of role or function or duties of valuer. So to act as an advisor, a good advisor, a valuer need to have sound technical knowledge and clear understanding of the basic principles of valuation. A valuer has following key functions: site inspection, collection of information and data, study of property market, analysis of sale, estimating fair rent, capital value, rate of interest, economic condition, capital appreciation and capital erosion, and last is economic factor. So these are the key functions of a valuer. Let us discuss all these 10 functions step by step. The first function was site inspection. On receiving and accepting instructions from the client, the valuer should visit property to be valued to check physical condition of the building, expected future economic life, client's interest in the property, etc. He should also inspect nearby areas to check rental and sales transaction of similar and comparable properties. Collection of information data. Once valuer decides about the method to be adopted for valuation basis following 4 factors, these are the 4 factors, he should collect data and information without any bias or pre-notion. So what are the factors on which the valuer should decide upon the method of doing valuation, client's interest in the property to be valued, purpose of valuation, material date of valuation, date and information available or is likely to be available. So whatever information we are going to get. So market, cost, income approach, which approach has to be followed, it depends on valuer has to decide on that method based on these following 4 factors, and once he decides about the method, he should collect data and information without any bias or pre-notion. Study of property market. Then in addition to study of rental and sales transaction, the valuer is also required to analyze genuinity of sales and sales instances, year purchase, ROI yields, and compare ROI yields with other alternative investment options. So whatever data has been collected from the market, genuinity of the data is also required to be checked by the valuer. Analysis of sale. While analyzing existing sale instances, the valuer is required to calculate YP, year purchase of each sale instance as under. So YP of each sale instance is equal to purchase price including black money here of sample property divided by net annual income of the sample property. So for each property, the valuer, as a valuer, we have to estimate the actual price including cash component if any in sale transaction. So that price we have to assess from the market, and net annual income from the property. So that will give us the year purchase for that specific sale instance. Then capitalization rate of sample sales instance can be calculated by either of the 2 following methods. So remunerative ROI and accumulative ROI. So remunerative ROI, we know capitalization rate is calculated assuming perpetual income. So in case of remunerative ROI, we assume single income and a single perpetual income. So that means R is equal to 100 divided by year purchase, YP. And in case of accumulative ROI, here capitalization rate is calculated assuming terminal value of the property, that is dual income. So recoup rate, if you remember in previous session we had discussed. So single income ROI and double income, recoupment or sinking fund ROI. Estimating fair rent. The valuer then try to estimate the fair market rent of the property to be valued with the help of rental data and sales instances which are let out. The valuer can estimate the fair market rent of the object property by comparison, that is by market approach method, with the properties involved in the instances of rental. The said comparison can either be direct or weighted score system. So if you have not gone through the market approach series or income approach series and cost approach to valuation, these 3 valuation techniques methods are there. If you have not gone through those PPTs in the previous session, you will not be able to understand all these slides. So there are 2 methods, direct or weighted score system. Direct is simple. We do it as you have understood in previous sessions on market approach to valuation. And here in weighted score system, here certain factors, as many as 50 to 60 factors of the subject property, can be compared with that of sales instances property parameters. So sales instances is sample data. Appropriate weightages are then assigned to each of these factors compared to calculate the total weighted score. So then first we identify certain factors of each sale sample property. Then we assign certain appropriate weight to each of the factors. Once TWS is calculated, total weighted score is calculated. Fair market rent of this subject property can be calculated by comparing the following 4 parameters of sales instances. So area, total weighted score, date of transaction or date of verification, and rent per unit area. Capital value. Documented value of sale instances is normally less than the actual price because of involvement of cash component or black money. Thus, valuer need to skillfully collect additional information by interviewing persons having first-hand knowledge of sales transactions like vendors, purchasers, witnesses to sale transaction, etc. Capital value without adding black money, if any, would give vague results. The valuer is also required to calculate rate of interest or capitalization rate. Generally, ROI varies in following ranges. So for residential properties, it varies between 4 to 5% irrespective of the places, from small towns to metropolitan cities, and irrespective of time in general. However, it varies according to changes in the general economic condition as revealed by economic indices. However, in case of commercial properties, rate of interest yielded by commercial building normally ranges between 6 to 10%. It is higher than the residential properties, or more, even more than 10% also, depending on the goods and services sold out of the commercial building. So it is important the actual ROI or capitalization rate of commercial building depends on the goods and services sold out of commercial building. Let us understand this with the help of an example. If building is selling daily essential needs like grocery shops, bank, etc., these buildings may yield lower ROI or capitalization rate, say 6%. However, buildings selling goods, services purchased once in a while like jewelry shop may yield higher ROI of interest, higher ROI or capitalization rate, say maybe 10%. Valuer is also need to compare rate of interest yielded by the subject property which is to be valued with rate of interest yielded by other forms of investments, which has been indicated by economic indices like BSC, NSC, bank rate, inflation rate, foreign exchange rate, etc. So normally graph of rate of interest yielded by properties or real estate generally runs parallel to the graph of BSC and NSC or Nifty indices, capital market indices, except in case of boom period the graph diverges, and in case of recession period the graph converges. So these are the important things. So in the areas where dollar economy is dominating factor, the rate of interest yielded by property changes inversely with the change in dollar exchange rate, and increase in inflation rate results in increase in level of rents and thereby causing increase in property value with time lag. So please remember these 3 simple points from examination perspective. Capital appreciation and capital erosion. It has been observed that rate of interest yielded by properties like residential yield 4 to 5% is less than those of 8.5 to 9% yielded by gilt-edged securities, the long-term government securities. It is normally observed that if government securities are treasury bills, government securities are yielding 7-8%. So properties normally, real estate normally give a yield of 3 to 4 or 5%. It is lower than the government because this is because property prices increase with inflation, and that is capital money invested into gilts doesn't experience any capital appreciation and is subject to capital erosion. So if we put in some money in any government security, then we get only interest and our capital remain constant. There is no scope of capital appreciation, only interest amount we get, right? So because of inflation, purchasing power of that capital originally invested in the gilt security gets reduced. Purchasing power of the capital invested in gilt security over a period of time, it gets reduced. However, in case of real estate, it is assumed that value of the property will also increase at least in tandem with the inflation, in sync with the inflation, more or less plus minus few basis points, and along with that we also get some rental yield income out of the property. That is why that income from the property remains less than that of the yield generated by government gilt securities. Please note that the Honorable Supreme Court of India seems to have overlooked this fact, since the fact might not have been brought to the notice of Supreme Court by parties concerned. Thus, in case of real estate matters, the appropriate capitalization rate would be 8.33 to 12.5%, which may be correct in case of developed countries where towns have almost reached saturation point. Town growth is slow and inflation rates are as low as 2 to 3%. So if we go through the various decisions given by Supreme Court of India, so Supreme Court has kind of overlooked this factor of capital appreciation and has given ruling for various rulings and decisions in favor of the capitalization rate, justifying in the range of 8.33 to 12.50%. And since our is a developing country, India is a developing country, there is a high inflation. So if we will talk about developed countries where township have already been developed and inflation, these countries, developed countries, are able to manage at a low level. Normally developed countries have low inflation, 1%, 2%, or maybe 3%. However, developing countries may have inflation of 5, 6, 7%. So in case of developed countries, there is no much inflation, so capital appreciation in the properties is not much. So in those cases, capitalization rate considered for the properties is almost matching with the maybe higher as compared to developing countries. Economic factors. Since valuer is required many times to give opinion and advice about the possibility of changes in rental and capital value of the property, he need to study effect of following factors. So as a valuer, I may be required to give my opinion about the future scope of the rental or likely increase in capital value of the property. So as a valuer, I need to have understanding of these factors. Physical factors like population, employment, development of infrastructure, spread of township, changes in legislation like Rent Control Act, bylaws, etc., local bylaws, building bylaws, changes in government policy like fiscal policy, CRR, bank rate, they also affect the valuation of the property and likely future income from the property. Economic factors like demand, supply, or both GDP, per capita income, domestic savings, investments in other forms of assets play major role in making the valuer to opine about future trend of real estate market. The valuer is also advised to study changes in NFCF, National Fixed Capital Formation, excluding stocks in hand which can be manipulated, of various sectors of economy, especially those in construction, which is supply of real estate, and in real estate, demand of real estate, so as to know trends of future. So to have a better understanding of likely trend, likely demand of real estate in the future, so and the study of NFCF is must, but valuer should exclude stock in hand because it can be manipulated to some extent. The information about NFCF is available at national and state level. These give enough indication of trends in real estate market. So last topic of current session is duties of valuer. So broadly, all duties of valuer can be subdivided into three major categories: duties to client, duties to profession of valuer, and duties to society. 1 mark theory question can come out of only this slide. So let us go through each of these three duties to deep dive. Now first duties are duties to client. A valuer should take care of his client that is expected from an ordinarily competent professional valuer. However, if the valuer claims himself to be highly experienced expert and reputed valuer, his standard of care should be such that as expected from such highly experienced expert valuer. So if valuer fails to maintain standard of care as expected, he may have to face charges of negligence. The declining factor for negligence charges is not the result given by the valuer, but the process being followed by the valuer to come at the result. So this is the important point. So it is not about result or the property value which I have given, basis which my negligence as a valuer, my negligence will be established. But if I have adopted a proper process to arrive at the value of the property, then my negligence cannot be proved. Thus, valuer should do reasonable care in performing a professional valuer. So while doing valuation of the property, process is more important, not the conclusion. Next set of duty is duty to profession. perfect integrity and full involvement in subject matter. In case the valuer has any involvement with the property to be valued, it is primary duty of valuer to disclose it. A valuer should have no bias in performing this job. In case he is unable to give opinion as desired by the client, he should courteously refuse to accept the work. Honesty is the best policy. Next duty. In case valuer has not done something, he should not pretend to have done it. In which case he is prone to being exposed. When he has not done something, he should say so. Otherwise, he should also give logical justification for not doing it. So whatever I have done, I should take responsibility of it. Whatever I have not done, I should not take any responsibility of it. So true to his own conscience. Valuer should give opinion according to his own conscience and not according to somebody else's conscience. So if I have taken subsequent opinion from anybody else, be it valuer or any other expert, so I should not totally rely on that thing. I should hear everybody's view, but as a valuer, final view is mine. So whatever I feel as a valuer, I should give that valuation in my report. Remember, no one can ever deceive one's own conscience. So thus professional standards for valuers can be summed up into 3 simple words: honesty, integrity to profession, and one's own conscience. 1 mark theory question can also come out of this only one paragraph. Please remember. And last duty is duty to society. Performing duties to profession will in general take care of his duties to society. So if I'm taking care of if I'm ensuring my duties towards my profession, it will also take care of my duties toward the society. So that's all in today's session. Thank you very much. So before I'll tell you what we are going to have in our third session, next session, let me tell you, please subscribe to this channel and click on bell icon so that you will be notified about next section which I am going to upload soon. Examples, and next session we are going to discuss about various examples and number of case studies on capital gain valuations. So this is going to be a very interesting topic and straightforward if any case study up to 12 marks may come out of this chapter. Thank you very much.